How to make money online from stocks. Ask any financial expert and you'll hear stocks are one of the keys to building long-term wealth. But the tricky thing with stocks is that while over years they can grow in value exponentially, their day-to-day movement is impossible to predict with total accuracy. Which begs the question: how can you make money in stocks? Actually, it isn't hard, so long as you adhere to some proven practices and practice patience. Buy and hold. There's a common saying among long-term investors: time in the market beats timing the market. In short, one common way to make money in stocks is by adopting a buy and hold strategy, where you hold stocks or other securities for a long time, instead of engaging in frequent buying and selling, aka trading. That's important because investors who consistently trade in and out of the market on a daily, weekly or monthly basis tend to miss out on opportunities for strong annual returns. Consider this. The stock market returned 9.9% annually to those who remained fully invested during the 15 years through 2017, according to Putnam Investments. But if you went in and out of the market, you jeopardized your chances of seeing those returns. That means you have to stay invested for the long haul to make sure you capture the stock market at its best. Adopting a buy and hold strategy can help you achieve this goal. Opt for funds over individual stocks. Seasoned investors know that a time-tested investing practice called diversification is key to reducing risk and potentially boosting returns over time. Think of it as the investing equivalent of not putting all of your eggs in one basket. Although most investors gravitate toward two investment types: individual stocks or stock funds, such as mutual funds or exchange-traded funds, ETF experts typically recommend the latter to maximize your diversification. While you can buy an array of individual stocks to emulate the diversification you find automatically in funds, it can take time, a fair amount of investing savvy, and a sizable cash commitment to do that successfully. An individual share of a single stock, for instance, can cost hundreds of dollars. Funds, on the other hand, let you buy exposure to hundreds or thousands of individual investments with a single share. While everyone wants to throw all of their money into the next Apple, AAPL, or Tesla, TSLA, the simple fact is that most investors don't have a strong track record of predicting which companies will deliver outsized returns. Reinvest your dividends. Many businesses pay their shareholders a dividend, a periodic payment based on their earnings. While the small amounts you get paid in dividends may seem negligible, especially when you first start investing, they're responsible for a large portion of the stock market's historic growth. Nifty 50 has had around 12% returns since inception, and when dividends were reinvested, however, the percentage jumped to almost 16%. That's because each dividend you reinvest buys you more shares, which helps your earnings compound even faster. That enhanced compounding is why many financial advisors recommend long-term investors reinvest their dividends rather than spending them when they receive the payments. Most brokerage companies give you the option to reinvest your dividend automatically by signing up for a dividend reinvestment program, or DRIP. Choose the right investment account. Though the specific investments you pick are undeniably important in your long-term investing success, the account you choose to hold them in is also crucial. That's because some investment accounts give you the benefit of certain tax advantages, like the National Pension Scheme, NPS. It lets you avoid paying taxes on any gains or income you receive while the money is held in the account. This can turbocharge your retirement funds as you can defer taxes on these positive returns for decades. The minimum amount required to open an NPS account is INR 500, and each subscriber can have a maximum of one account. NPS TRI is a tax-free investment exempted from tax at all stages of investment and return. The invested amount, interest earned on it, and the total amount withdrawn at the end of the scheme is all tax-free. One can take out up to 60% of their total investment after the age of 60. This 60% investment will be considered tax-free. If you want to make money in stocks, you don't have to spend your days speculating on which individual company's stocks may go up or down in the short term. In fact, even the most successful investors, like Warren Buffett, recommend people invest in low-cost index funds and hold on to them for years or decades until they need their money. Was this video helpful for you? Let us know in the comments section and subscribe to remain in touch with such valuable content.